Okay, so welcome to part 2 of this video. Will the stock market bull run continue into 2021? Again, before watching this video, do check out part 1 of the video and let's get ready to continue. But before that, some quick messages. The second reason why this bull market could still last for some time is because we just finished a bear market in February this year and we just started a new bull market. Now, it's kind of like the weather. There are seasons and cycles. Now, if you take a look at the last 85 years, since 1935, there have been, let's see, how many bear markets? 1, 2, 3, 4, 5, 6, 7 bear markets. And we had a bear market in 2018, December 2018, because of the trade war, and a recent bear market was in February of 2020, the pandemic. So we've had a total of 9 bear markets in the last 85 years. So roughly it's like one bear market every 9 years. You can see the statistics that the market in the last 85 years have been in bears in 8 years, right? If you add up all the bear markets, if you add up all the bull markets, the ones in blue, you can see it's been 78 years of bull markets. So markets historically are in bull mode 91% of the time. 91% of the time, we are in a bull market. And 9% of the time, which is like once every 9 years, we go into a bear market. Remember, what happens after every bear market? That's right, the new bull market begins. And how long do bull markets last? Well, this one lasted 9 years, this lasted 5 years, 12.8 years, 12.9 years, 2 years, 6 years. It varies, okay? So, like I said, we just finished a bear market in February this year, and we just started a new bull market. So how long will this bull market last? No one can tell. But the thing is, it could last for 2 years, 5 years, 9 years, or another 13 years. We just started a new bull market. So like I said, it's just getting started. Now, many people find it very hard to believe, how can the stock market keep going up when the economy is tanking, when people are losing their jobs, when companies are going bankrupt? How can this be? The stock market is detached from reality. What these people fail to understand is that the stock market is not a fair representation of the real economy. The stock market, which keeps going up, is represented by the S&P 500. The S&P 500 is a basket of the 500 most dominant, strongest companies in America, and some would say even the world. So these are companies like Amazon and Facebook and Google and Microsoft and Apple and Johnson & Johnson and Visa. So these companies make up the bulk of the index and the stock market. And these companies, number one, are very well capitalized. So in other words, they've got a lot of cash on their balance sheets. They can borrow unlimited money from the financial markets. They're in dominant positions. And in fact, many of them are doing better under the pandemic. Their sales are growing, their profits are growing because they are technologically enabled to survive and prosper during the pandemic. The stock market does not represent the majority of the thousands of small to medium private companies, which are, many of them sadly are going out of business because they don't have enough cash, they've got a lot of debt, and they're not technologically enabled. So while we see that the economy, the real economy, again, businesses are failing, people are going out of business, but again, the stock market doesn't represent these companies. The stock market only represents these giants, right? And COVID has disrupted these small and medium-sized private companies, right? So cafes are closing, retail outlets are closing, and so on and so forth. And ironically, this is actually helping the S&P 500 companies. Why? Because they have less competition. Now think about it. Think about how many coffee shops and cafes have closed during the pandemic. Thousands of them have closed. So coming out of the pandemic, Starbucks is going to be even stronger and more dominant than ever before. and they're going to make even more money than ever before, and they contribute to the S&P 500 going up even more. Think about how many retailers, mom and pop shops are going bust. Hundreds of thousands of them are going bust, sadly. And who's going to benefit? Amazon's going to benefit. eBay's going to benefit because, again, they're going to have less competitors. And these companies make up the S&P 500. And all the more private companies go bust, the higher up the stock market is going to go. The fourth reason why the stock market could keep going up is because it seems to be the only profitable game in town. What do I mean? Now, with the Federal Reserve keeping interest rates near zero, and they say they're going to do that for at least 2 years, right? Zero interest rates plus, they say they're going to allow inflation to run above 2% for the next 2 years. So what does it mean? It means that if you hold cash and inflation is 2%, it means every year the value of your money falls by 2%. So think about it. In 20 years, 20 times 2 is 40%, which means in 20 years, you're going to lose 40% of your purchasing power. So the worst investment you can have would be in cash, because every year that you hold cash, you're losing 2% of your wealth. What else can you put your money? Where else can you put your money? Bonds, all right? So bonds represent the risk-free rate. We look at the 10-year treasury yield, which is the interest rate paid by 10-year government bonds. And currently, the 10-year treasury bond yield is 0.65%. So does it make sense to buy bonds? No, you got to be really dumb to buy bonds, right? Why? Because you buy a bond, basically you're getting 0.65% return a year for locked in for 10 years. But every year you're losing 2% to inflation, which means your real return after inflation is minus 1.35%. So in other words, holding cash makes you lose money every year. Holding government bonds makes you lose money every year. Where else can you put it? The only place you can invest is in equities and the stock market. Now, don't talk about cryptocurrency or gold, because those are speculative assets. Those are not productive assets. We're talking about productive assets that produce things. So what is the yield that we get from the stock market? The yield that we get is known as the earnings yield. And the earnings yield is the inverse of the PE ratio. That's right. So if you take the price to earnings ratio of the market and you invert it, it becomes earnings divided by price, which means how much profit you get based on the share price you pay for. This is called the earnings yield. So currently the earnings yield on the S&P 500 is 3.8%. So in other words, putting your money into stocks yields you 3.8%, which is higher than the 0.65% you get from treasury bonds. As long as stocks give you better yields than treasury bonds, money will flow towards stocks, giving the stock market more and more ammo to keep moving up, because money has to flow into one of these assets. And remember, because of all this quantitative easing, we've got a lot of liquidity, a lot of cash in the markets from the wealthiest 1% that control 90% of all the money. Their money will flow into equities. Now again, remember, some people say, hey, right now the market looks like the year 2000, the dot-com bubble burst when the market was expensive. It looks like 2007, 2008 financial crisis. It's not a fair comparison. Why? Let's take a look at this chart. You can see that back in the year 2000, which was over here, the year 2000, the dot-com bubble, you can see that the red line, which is the US Treasury yield, was above the S&P 500 earnings yield. In other words, bonds were more attractive than cash in the year 2000. Hence, money flowed from stocks to bonds and the stock market collapsed, right? During the financial crisis in 2008, same thing. You can see the red line. Again, the bond yields were higher than the stock market yields. So once again, money flowed from equities into bonds. What we're seeing right now is the total opposite. Right now, the blue line is above the red line, which means earnings yield from the S&P 500 is higher than treasury bond yields. That's the main difference that people are not catching. So the difference between the earnings yield and the treasury bond yield is called the equity risk premium. As long as the equity risk premium is positive, it makes sense for money to keep flowing into stocks. Currently, the equity risk premium is 3.15%, which is positive. Whereas again, in the dot-com bubble and the financial crisis, the equity risk premium was negative. But the most important reason number 5, why I think that the economy will rebound very strongly next year and the stock market will continue going higher is because of the vaccine. That's right, the vaccine is truly a game changer. It changes the entire narrative of the situation. So again, recently Pfizer and Moderna have now developed this vaccine that's 95% effective against COVID-19. I'm from Singapore and we've already, ordered all these vaccines and we're starting to vaccinate the population by December of this year. And the goal is by third quarter of next year, everyone in Singapore, almost like 100% of us will be vaccinated, which means life will be back to normal. No more quarantine, no more masks, borders will be open and we can go back to business as usual. UK has also approved this vaccine for their population. Japan has also committed to vaccinate their whole population and hopefully the US will follow as well. So once everyone is vaccinated by third quarter next year, you can bet there's going to be a lot of pent-up demand. People want to start traveling again. People want to start eating out in restaurants. People want to start going to the pub, go to the movie theaters. And again, all this pent-up demand together with everything reopening, with the vaccine, is going to drive the economy a lot higher and the stock market as well. This does not mean that you should go out there and just buy any stock that you want to and expect to make money. No. To be a successful investor, you have to select only the best companies. You should only buy shares of companies with wide economic moats that dominate their industry, that have got very little or no competition. You should buy companies with growing sales, profits, and free cash flow. Companies that have conservative debt. Companies that have a sustainable competitive advantage. And most importantly, only buy shares of companies when the price is selling below its intrinsic value. So you have a margin of safety. Now, if you look at the markets, there are some companies that are way overpriced, that are ridiculously expensive. And I'll show you some examples in a while. But there are some companies that are great, but are reasonably priced. So let me just show you a few right now. So an example of a company that's still reasonably priced would be Facebook. Now, Facebook, the intrinsic value, if you calculate a 20-year discounted cash flow, is worth $306. So currently at $281, it is still slightly undervalued. So that makes it a pretty reasonable investment. At the same time, I like to buy when it retraces to a level of support. So you can see the price action, right? It waves up, wave down, wave up, wave down, and it finds support, as you can see, at this 100 moving average. So if it retraces somewhere to about 269, that could be a level to add shares. Now remember, as an investor, we always want to average in. You always want to add in stages because you never know how deep a retracement can go. So the first retracement would be about 269. If there happens to be a deeper retracement, where could it go to? Well, you could zoom out and take a look at the weekly charts to get another perspective, right? So you can see on the weekly charts, you see a level of support over there at 230, another level of support here at 246, and that first level I talked about was about 269. So in other words, if you see again, Facebook retracing to 269, that could be a potential to add shares. If it happens to be a deeper retracement, it could go down to 246 or even 230, and we will add shares at those levels. And by this level, 230, it should be oversold enough to then continue its journey upwards. Okay, so that's Facebook. Another example would be Alibaba, right? Ticker symbol BABA, and because of some bad news over its end financial listing and the Chinese government being more restrictive on its monopolistic practices, there was some retracement. So intrinsic value between 278 to 298, currently at 266.9. Again, it's slightly undervalued. And again, if you look at the price action, you can see, again, previously very strong support at this 150 moving average, and also a support at this 50 moving average, and this previous swing high turn support. Okay, so very strong level at 241, 227, and currently at 265, 266. There is also a support level. Let me just zoom in and show you on the 1 year daily candles. That's right, you can see recently this is a strong level of support resistance. Okay, and it looks like it's bouncing off the support and potentially going higher. So one could add shares at this level, 266, but if it does break down, these would be the next two levels to add shares, and that would be the lowest it would go for now, and then it will just continue journey upwards. Great companies always rise in value. They will always go up. The only question is, in the short term, how far will they retrace? You can't always know for sure. That's why we add in stages. All right. Another example would be Microsoft. Great business, always goes up over time, but still undervalued. Intrinsic value 235 to 243, and currently at 214. It's pretty good value that you get from this company. And again, you can see currently it has been going sideways. After a strong run up, it's now consolidating, right? So there is a support level at about 208 to 212. That will be an area to add shares. If it does break lower, the next level of support, the lowest it would go would probably be about the 200 moving average at about 190. So again, goes to show you in the market, there are great businesses that are still undervalued. Now, at the same time, there are also companies that are way overvalued, and this would be companies that I may trade on the short term with a stop loss or using options, but again, I wouldn't dare to invest in them because they are just way overpriced. An example would be Zoom, for example, right? This is way overpriced. Current price, $413. Now, if you calculate the intrinsic value, the highest you're going to get is 176. That's right. That's the intrinsic value. It's right now at 413. It's 135% overvalued. Now, not saying it's going to crash next day, next week, next month, right? Because from an overvalued can become even more overvalued. We call that the greater fool's game. Okay, so which means if you buy it $400, you are a fool. But you could make money if you sell to a bigger fool willing to pay a higher price and buy it from you. So it could still keep going up. Now, we can't always predict the short-term direction because in the short term, prices are driven by emotions, not by logic. So if you think logically and rationally and you actually do the numbers, the value of Zoom is only 176. So sure, I could trade Zoom, I could use options, a stop loss, I could trade on the way up, but to invest it and hold it, no. I'll only do it if it gets below 176. But even then, I'm not sure because Zoom is a great platform. I use it as well, but it can potentially be disrupted by competitors with deeper pockets like Cisco Systems or even Microsoft. So it's a company that I will not invest in, for example. Another company is NIO, the electric car company in China, right? Right now, it's a momentum stock, keeps going up, hot stock, selling at $45. But again, if you do the intrinsic value, it's only worth $29. So it's about 30-40% overvalued. Sure, it can go higher. Short-term emotions, sentiment drives it higher, but it's again not a stock that I would dare to invest in. Right? So, for me as an investor, I never think about how much money I can make. I always think about how much money I can lose if it really starts to go down. So as long as I invest in great companies that are undervalued, it's impossible for me to lose money. So I do hope my sharing has been useful. So until next time, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.